my name's Tracy Gerling, and I'm a group retirement consultant with NFP Canada. This is part of our Big Question video series where we speak with subject matter experts on topics that are important to employers and employees right now. Today I'm speaking with my colleague Fergus Meldrum. He's our VP of Group Retirement Sales, and he looks after investment oversight for many of our large Canadian clients. Today, Fergus will give us insights into riding the markets through volatility and what it means to stay the course. So Fergus, to start us off, can you provide a brief summary of what's happened in the markets in the last few months?
Sure, Tracy. I mean, I would say that, what we're experiencing right now is historic on so many levels. I mean, we've never seen the world's economy voluntarily close because of a situation like COVID-19. The good news is that from a market perspective, April was one of the better performing months that we've seen, and May has also continued to be positive. That being said, obviously when the news broke, many employees certainly felt the downturn. When you look at the US and the Canadian markets, kind of at their low point, they were down north of minus 30, 35%. So significant downturn. I would say from a Canadian perspective, though, there's certainly some other challenges. Energy, so the price of oil has certainly been a major issue with the price war between the Saudis and the Russians. I would also say that, when you look at the Canadian economy as well, I mean, it's important to note that it is very much resource based. And so, we're certainly going to feel that energy downturn. When you look at kind of where we're moving, though, many of the world's economies are kind of moving down to a stage one, where the plan is really to try to reopen and see kind of where things go. Obviously, the challenge there is that if there is more outbreaks of the virus, we could continue to see significant volatility in the market. So, we're certainly not out of the woods yet. I would say there's going to be a lot of volatility ongoing, but, it's good to hear that, many of the countries that are dealing with COVID-19 are attempting to reopen.
And how have group retirement plans fared during this volatility?
Over the last few months, I've been looking at the returns for many of our plans, and I would say that, although they are certainly down, the impact of the virus has not been as significant as you might think. The reason for that primarily lies in the fact that most employees are investing in managed products. So they're either in an asset allocation fund where it's tied to their risk level, or they're in target date funds. Now, if the employee is selecting the fund that truly matches who they are, what we've seen is that the older employees, although they're certainly down, the amount that they've lost compared to the actual market has been quite a bit lower. And for those for those younger employees, I should say, certainly they've felt the downturn. But once again, because of the diversification that so many of these products offer, and the fact that there is a bond component in almost all of those products, it's not a perfect correlation to the volatility we've seen in the market. So, although we've seen the challenges and things have obviously come back a little bit, a lot of the plans are still down, but I would say that, the managed products really have kind of softened the blow for many of the employees in our retirement programs.
So we've heard a lot recently about emotional investing and the importance of not making investment decisions based on our emotions. Uncertainty and market volatility can make people anxious, which can lead to having them make poor investment decisions. So Fergus, what advice can you offer individuals to help ease their minds and to help take that emotion out of making those investment decisions?
I mean, it's easier said than done. No doubt, when you see the market drop 20, 30%, the first thing most employees consider is, should I get out of the market altogether? When you look at the history of the market, and especially after significant downturns, pretty consistently, you've seen that the market return to its original valuations within a year or two of the significant downturn. And so I think what that tells us from a historical standpoint is that, you want to be patient, you want to stay the course. When you look at a group retirement program, there are some things that I think are advantages, when you're considering a down market. First off, dollar cost averaging. Most employees are contributing on a per pay basis. And so what that allows the employee to do is in a down market, they're buying more units at a lower price. And so, that dollar cost averaging can be quite beneficial in a down market. I would also say that most company plans offer some sort of matching, it's some sort of matching program. And so what ends up happening there is the employees actually realizing an immediate return on their initial investment outside of just the market performance. And so, that match really does come in handy in down markets. And then finally, as I mentioned earlier, target date funds, managed products, because these funds are managed to match who you are, even in a down market, it's good to know that you're invested ideally for someone of your age. And then for those employees who are close to retirement, a lot of the risk is removed from those managed products. And so, that generally means they're not seeing the volatility that, they would have seen if they'd say tried to build their own portfolio. So, easier said than done, but be patient, take advantage of dollar cost averaging, your match, and really focus on managed products as an investment choice if you're not someone who is an expert when it comes to investing.
Thanks, Fergus. So historically, like you've said, we've seen stocks generate long-term gains despite the market, despite the many short-term declines that we've seen caused by global events. Although our current situation is unlike anything we've ever experienced before, some people relate this to what happened in the markets in 2008. Many of us saw or were privy to that significant downturn we saw. So how does this compare to what we saw in 2008?
I mean, there's certainly some similarities in regards to the volatility, but both situations are very different. I mean, back in 07, 08, it was really about potentially the financial markets crashing, and the flow of liquidity could completely freeze up from one institution to another. What we're experiencing today, I would say it has a greater impact certainly on GDP, primarily because of the fact that literally we've closed businesses. And so, that's one big difference. I would say another big difference is, from a bailout perspective, no doubt the Fed has really stepped up and thrown billions of dollars to support many of us. But the challenge there is that if the virus continues to kind of stay active, within cities and countries, there is concern that, how long will this stimulus, the amount of money that's been thrown our way really continue to kind of buoy the markets. And so back in 07, 08, they were able to bail out some of these financial firms, which allowed these companies to move forward. And so it was a bit of an easier fix. The other thing I would say is that, Main Street is really going to feel the impacts of COVID-19. And we're starting to see that with bars and restaurants closing, simply because, a lot of these smaller business owners, they don't have the capital, the liquidity to last more than a few months without bringing any sort of revenue. And so, GDP, the impact on Main Street, and the fact that, from a bailout perspective, it's certainly going to be more challenging the longer the virus is active within the community. So those are really, I think, really the key differences between 07 and 08. And there just seems to be a lot more uncertainty when we're dealing with this virus and how long it may take for us to get a vaccine.
Great, thanks, Fergus. So finally, to finish things off, Fergus, what is your best piece of advice that you can offer to investors going forward?
As I had mentioned earlier, I think really, staying the course, being committed to continually saving. Um, the last thing we want employees to do is to stop putting money into their retirement savings program. Now is a great opportunity. It's a great buying opportunity. For the last several years, we've seen tremendous markets, and some experts have said that from a valuation standpoint, things were getting, far too expensive. And so, this is allowing almost a reset. And so I think employees do need to be patient. I think continue to focus on those managed products, make sure you're in the right managed product for who you are. And as mentioned, dollar cost averaging, great opportunity in a down market for you to buy more units, bring down those average prices, so that when the market does kind of come back and we move into a new normal, you can reap the benefits of what you've seen in the down market from those perspectives.
Great. So thanks so much for your time today, Fergus. And remember to check out nfp.com for our latest insights and updates as we continue to move through this ever-changing environment.